So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statement? I will go step by step, including valuations when we get to that point, in how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Let me share my screen with you. Come back here. Okay, so as you can see, we've had a lot of engagements and talk in the comment section about this, specifically from Gustavo and Luke. Thanks for talking with me about this. This company one over here, actually, first off, which of these companies do you think looks best on a preliminary basis, just based on the numbers? Yes, again, I talk all the time about how numbers are not the only thing, but that's kind of where I start, is the numbers. Okay, now that you've had a little bit of time to look and think, I'd love to hear your comments below about which one you think is best. I'll tell you which one. This is the company that I'm looking at as a potential investment. Column 1. These other 3 companies are companies in the same, or in the company one's industry, sorry. They're all in the same industry. They all should have similar economics. These 3 are worldwide companies. This is trying to become a worldwide company, but it's mainly a regional company right now, a countrywide and regional company. These 3 companies, this company I can almost guarantee you've never heard of unless you're Indonesian, because it's an Indonesian company. These 3 companies, you've probably at least heard of all of them, and you might own them in your portfolios. That's how big they are. So this company, the reason I'm looking at this company, is because it's a smaller company. It's a more obscure company listed on the OTC and ADR market in the United States. I think it's, as of this recording, it's about a $2 to $3 billion company. These companies combined, I think, are $150 billion. I focus on smaller companies, more obscure companies, because that's where I believe I can gain an advantage over other investors who either aren't willing to look in these areas or don't know how to research companies and find good companies in these areas. Because on the OTC markets, and I tell people this all the time, this is my favorite place to invest, because most people either can't or won't look here because of the size of the company and the perception of most of the companies. Perception is true, though. 99 probably % plus of these companies are terrible on the OTC markets. But if you know what you're doing, you can gain a huge advantage by investing in these kinds of companies, the good ones, and by knowing how to find them. Because again, most people won't look at these companies, or they can't look at them based on their sizes or legal requirements or whatever. OTC market is where I've earned most of my returns. OTC market and nano caps, micro caps are where I've earned my investment returns over the last 8 years. The majority of investments, off the top of my head, I think actually almost all of my investments started as OTC companies, tiny companies, sub $500 million companies. So if you know what you're doing, you can earn high returns here. But again, I have to say this: if you don't know what you're doing, do not invest here, because you're going to get hammered, because most of these companies are absolutely terrible. Okay, so with that preface, that's the reason I'm looking at this company. But I'll kind of go over the highlights here of why this company is more attractive, not only to me, but when I asked in the comments over here, Luke said company went, and so did Gustavo. So 7.5% dividend yield. Compare that to the free cash flow to sales yield. Looks awfully high, doesn't it? The reason this is so high is because the company, with this coronavirus and market crash stuff that's been going on, the company shares fell pretty significantly, pretty fast. I think 35, 40% their shares fell in the last probably less than a month. That's why this is so high. Price to book, 1.1, 5.6, 4, and 7.3. Again, all these companies are in the same industry. So they should have relatively the same price to book. This company's price to book is significantly lower than the other three companies. The increase in book value, again, higher than the other companies. And this company right here is actually negative over the last 10 years. Book value, for me, these first two things, or these second and third things we talk about here, they're not super important, but generally you want to see this going up over time, because I use this as kind of a proxy for, I use book value as a proxy for the underlying value of the company. If it's going up, that means the underlying value, intrinsic value of the company is going up. If it's going down, that means the underlying value of the company is going down. Again, this isn't a massive deal, but generally I want to see this going up. And this is the highest of this. So this is where things get a little bit trickier. So this company is 13.4% operating margin, trailing 12 months. Higher, higher, lower. 5-year average, same thing. Higher, higher, lower. So which company is better based on these metrics? It would look like these, correct? These two. But is that really true? That's why you keep doing the rest of the analysis. That's why I do all of this, because you can't just rely on one set of numbers. You need to rely on the whole picture. ROIC, 9.2, higher, higher, higher. They're all higher. Same here, they're all higher. So again, which company is better? This looks like the worst company right here. But again, is it? That's why this number, these two numbers, trailing 12-month ROE and 5-year average ROE, are here. This is where I kind of separate things out to a large degree. ROE. The reason I don't use ROE as a metric for anything other than as a comparison to ROIC. I use ROIC and operating margin and free cash flow to sales as my major kind of profitability metrics, some of my major profitability metrics. So why is ROE here if I don't really use it? Because with these here, compared to ROIC, I can immediately tell this company has a decent amount of debt. This company has a large amount of debt. This company has a large amount of debt. This company has a large amount of debt. Why? Because ROE is levered by debt, while ROIC is not. Meaning, the more debt a company has, the higher its ROE is in relation to its ROIC. So for this company, its ROIC is, this company is even better, 9.9% for this company in the trailing 12-month period, while its ROIC is almost triple that. So it has significant debt loads. Same thing here. Significant debt loads. This company is not as bad, but this company has the lightest debt load of the four. So is this company really the worst when it comes to the metrics, or are these companies using an enormous amount of debt to lever their returns? I think these companies are in general using too much debt for their sizes, and that will show that down here further. But so that's not only what we can tell here, but again, we'll talk about that further down here more. So let's keep going, figure out which company, or why I think company one is the best of these three. So free cash flow to sales, very high in the trailing 12-month period. Last 5-year average, not so much, not impressive. What this means to me is I need to think about whether I think this is going to be more, the 11.6 number is going to be more realistic going forward, or the 2.8% is going to be more realistic going forward. Frankly, I think it's going to be somewhere in the middle of those numbers based on reading the financial statements and seeing how much they've improved their operations and their efficiency. I think it's going to be somewhere in the middle. I don't necessarily think it's going to be as high as the 11.6, but I think it's going to be closer to that number than the 2.8% number, because they've been working on increasing their efficiencies over the last 5 years, cutting costs, raising prices, that kind of stuff. So here's another thing where we talk about debt. 0.24 debt to equity, 0.44, 1.53, 2.78. So these two companies have an enormous amount of debt. This company has a decent amount of debt. This company has the least amount of debt. And when we're comparing things to equity here, the reason a lot of these, pretty much 1, 2, 3, 4, 5, 6, 7, 8, 9 of the 1, 2, 4, 5, 6, 7, 8, 14, 15, 16. So more than half of these things are debt or debt related. The reason that is because as a deep value investor, I want to make sure that my company is safe. It's not going to go bankrupt. It's not going to have any major issues. It's going to be in business for a long time. These companies have failed that test for me. They have an enormous amount of debt. This company is all right, but again, we'll discard this company down here. So these two companies are left as of this point because of the enormous debt levels these companies have. Even though they have higher margins, it's not always about the higher margins. It's always about the higher margins and the lowest amount of debt for me. Because again, I want a gigantic margin of safety. I'm an ultra conservative value investor who hasn't bought in 5 years because I can't find anything that meets my criteria. One of my criteria is having an enormous margin of safety. If you have a large amount of debt compared to equity or cash, you don't have a large amount of safety. If you have a lot of cash in relation to debt, you have a larger margin of safety. So that's why I concentrate so much on this checklist with debt or things affected by debt. So let's keep going. EV to EBIT. So these are relative valuations here that I've used for probably 8-10 years now. I look for numbers below 8 to show me that the company is undervalued. This company is the only one that even comes close to those numbers. EV is enterprise value. This includes market cap, debt, cash, minority interest, and preferred shares. Total enterprise value, which is TEV, includes debt equivalents like operating leases and unfunded pensions, and things like long-term investments and deferred tax assets, if the company has any of those. So these to me are far better metrics to use than market cap. So this normally would be P divided by E, or price divided by earnings, and would be market cap divided by the company's earnings, or share price or whatever divided by the company's earnings. I don't like that. I've talked about it at length for many, many, many reasons, because it doesn't include cash and debt, which 99% of the companies have one or both of those. So this, I want to view, and for me as a deep value investor, the reason I don't like market cap on top of that is because I want to view as I'm researching a company as that I'm to buy the entire business right now based on today's numbers, today's information. What is the price I would have to pay for the entire company? Debt, cash, investments, unfunded pensions, operating leases, everything. Because operating leases, for example, are usually contractual, usually have long terms, 5 to 10-year terms, and even if a new owner comes in, they couldn't get out of the operating lease without having to pay some kind of massive penalty. That's why those are there. If you buy the company, you're going to have to pay for the unfunded pensions. If you're going to buy the company, you're going to acquire the cash. So this is why I like EV and TEV better than market cap. Okay, so this company is, according to my own criteria, massively undervalued or decently undervalued. These companies are massively overvalued. Massively overvalued right now. Again, I look for numbers under 8. These companies are averaging about, off the top of my head, was at 22, 23. This is at somewhere in the probably 18 range. This company is just off the charts. Right now, based on these numbers, at this point in time, this company looks like the best investment by far for the reason I talked about. Biggest margin of safety, lowest potential undervaluation. In terms of the relative valuations, again, after I do the relative valuations, I calculate intrinsic valuations, which we can talk about another time. but I want a gigantic margin of safety. I want the company to be healthy, producing healthy margins, have a healthy balance sheet. And this company is the only one that pretty much passes all of my checks. These companies pass some up here, but the debt just kills them. This one, the high price, this one's probably the most well-known. And that's why it's priced at such a high level right now compared to this one. Again, unless you're Indonesian, you probably have no idea what this company is. So let me get back to the video here. How do I stop sharing? Okay. So I hope this live training has helped. If you have any questions, let me know. I'm open for questions right now. I'll be on for a little bit longer answering questions if you have any. If you have any comments about anything, if you didn't understand something, let me know in the comments below. I want to help you understand all this stuff because this stuff is very important that we've talked about. And not only in terms of the footnotes at the beginning, but also in terms of this is how you can evaluate companies faster. This is what I just showed you is the checks on there are from my preliminary analysis checklist that I use every single day to evaluate companies faster. This is how I evaluated to some degree in the last 10-ish days, to some degree, 500 to 1,000 plus companies. Yes, I've skipped most of them relatively fast because of that checklist, but that's what the checklist is for. So I can get rid of the crap companies faster so I can spend more time evaluating the good companies or the good looking companies, again, on a preliminary basis. That's why I call it my preliminary analysis checklist, because even if a company, this company one over here that we were just talking about, it went through my checklist, looked up, got through the checklist, then I wrote financial reports on it. In 2 days, I read almost 600 pages worth of, 576 pages worth of its financial reports, of its recent financial reports. So after a company gets past this preliminary analysis checklist, I then have to read financial reports on it. Then after I did that, then I did that comparison spreadsheet we just talked about. There's always more research to do, always more stuff to look at, always more to learn when it comes to this kind of stuff. This is what I talk about with my students all the time. Is this one of the reasons I love value investing, and why, frankly, many people don't get good at it, is because there's always more to learn. There's always more to do. There's always more work to do. There's always something else to read. There's always some other Google source to check. And it takes a lot of time. It takes a lot of work. But that's how you earn higher investment returns. That's how you multiply your money. So I'm not seeing any questions coming in, so I'm going to get off here. But I hope this helped. We're going to be doing more training videos like this in the future. And let me know what topics you want to talk about, especially, again, I was going to answer questions at the end of this about general finance stuff, general investment stuff, just coronavirus stuff, whatever you wanted to ask me about. We'll be doing more of these as the coronavirus kind of panic and pandemic continues to unfold. But until next time, thanks for watching. Have a great day. Talk soon, and hope to see you on one of these live trainings very soon. Before I go, I almost forgot. We're going to be doing these live trainings with students only as well, masterclass and coaching program students as well. I'll have links for those below that for our programs if you want to join those. We're going to start these weekly training sessions back up again for students only, where we go in depth. Literally, one time a student and I went, he wanted to go over a company, and we spent 20 minutes talking about 7 words or 8 words on a financial statement. I just posted about that last week. So that's how in-depth we go. And if you want to join one of our programs to learn how to value invest, become more confident, earn higher investment returns, and frankly, be a better investor and be a better stock picker, find better and safer investments that will return you higher amounts, make sure to check out our programs. Again, I'll link those below. And until next time, thanks for watching. Have a great day. Talk soon. Bye.